You've probably heard that 90% of investors underperform the market. Most people hear that statistic and assume it's about bad luck. Wrong stock picks, bad timing. It's not about intelligence. It never was. The investors who consistently lose money are making small, predictable, almost invisible mistakes over and over again. My name is Nick, and I spend way too much time thinking about money, investing psychology. By the end of this video, you'll probably recognize at least 3 of these mistakes in your own behavior. Mistake number 1, trying to time the market. You watch the market climb for months, and some internal alarm goes off telling you it has to come down soon. So you sell, wait for the crash, and plan to buy back in at the bottom. Except the crash doesn't come. Now you're sitting in cash, watching gains pass you by, feeling worse with every green day. Missing just the 10 best trading days over 20 years can cut your total returns roughly in half. Mistake number 2, falling in love with your purchase price. You buy a stock at $50. It drops to $30. Now you refuse to sell because you're waiting to get back to even. The market does not know what you paid. It does not care. Your entry price is irrelevant. The only question is whether this is still a good investment today. Mistake number 3, expecting unrealistic growth rates. People love modeling out 15, 20, even 30% annual growth because it makes spreadsheet projections look exciting. A company growing at 15% annually doubles every 5 years. Keep that going for 20 years, and it would need to become larger than most national economies. You haven't built an investment thesis. You've built a fantasy with a ticker symbol attached to it. Mistake number 4, using borrowed money to invest. Leverage feels brilliant when it works. Your returns are amplified far beyond what your own capital could produce. But leverage is symmetrical. It amplifies losses exactly the same way it amplifies gains. A margin call forces you to sell at the worst possible moment, locking in losses you never would have taken otherwise. Mistake number 5, confirmation bias. And once you buy a stock, you start unconsciously seeking information that confirms you made a good decision. Bad earnings report? You decide it's temporary. Analyst downgrade? You assume they don't understand the company like you do. Great investors actively try to disprove their own thesis. They go looking for the strongest argument against their position. Mistake number 6, shrinking your universe of opportunities. A lot of investors only consider companies they've personally heard of, industries they already understand. The market does not reward familiarity. It rewards being right about value relative to price. Some of the best investments of all time were in boring, unglamorous companies most investors never even considered. Mistake number 7, mistakes of omission. It's about a great investment you didn't make because you hesitated, got distracted, or talked yourself out of it. Most investors remember their losing trades vividly, but they completely forget the opportunities they passed on. Mistake number 8, over-diversification. If you own 40, 50, 60 different stocks, you're not diversifying anymore. You're diluting. Your winners can't move the needle because they're buried under a pile of mediocre positions you added out of fear. Mistake number 9, excessive trading and unnecessary fees. Every trade has a cost. Those tolls compound just as powerfully as investment returns, except in the wrong direction. Activity feels like progress. It usually isn't. Mistake number 10, herd mentality. When everyone around you is talking about the same stock, fear of missing out overrides actual analysis. By the time an opportunity becomes a dinner table conversation, Much of the easy money has already been made. The crowd isn't usually early. The crowd is usually late. Mistake number 11. Investing outside your circle of competence. A lot of investors buy something purely because a friend mentioned it, without ever being able to explain what the company actually does. If you can't explain your investment thesis clearly to a 12-year-old in under 60 seconds, you probably don't understand it well enough. Mistake number 12. Lack of patience. Compounding requires time, not weeks, not months, years, often decades. Most of the wealth created by long-term investing happens in a small number of explosive years that are unpredictable in advance. If you're constantly jumping in and out trying to avoid the bad days, you inevitably miss the incredible days too. None of these mistakes are about lacking intelligence. They're about lacking discipline, patience, and self-awareness under pressure. The market doesn't punish people for being unintelligent. It punishes people for being emotional at exactly the wrong moments. Every single mistake on this list is avoidable through something far less exciting and far more powerful: consistency. Buying quality assets, understanding why you own them, ignoring the noise, and giving your money time to grow. The investors who build real wealth aren't the ones who avoid every mistake perfectly. They're the ones who make fewer of them and recover faster. If you recognized yourself in even one of these 12 mistakes, that's not a failure. That's actually the first step toward fixing it, because you can't correct a pattern you refuse to see. Take whichever mistake hit closest to home and just commit to interrupting it the next time it shows up. Small corrections, repeated consistently, compound into massive long-term advantages, the exact same way your money does.